Welcome back to the Thursday webinar series, as always, 11 o'clock. Today, the 27th of October 2016. My name, as always, is Stefan Friedrichowski. Yeah, warm welcome for today. You might realize that my voice is still a little bit, so to say, damaged, and I have still a cold, and I try to not cough here directly into my microphone. Hopefully, I have the chance before that to switch to mute my microphone so that you get not that disturbed. Okay, first of all, just a reminder that next week there will be no Thursday webinar, but instead of that there's another one, and this will be part of my topics for today. There's one on Tuesday in this case. So in 14 days I will be back here on our Thursday webinar channel. Yeah, topics for today. As always, I go through some questions first. There was one related to the lead lag strategy, which I presented last week. There's a quite cool indicator which helps to follow that kind of strategy. Then I will talk a little bit on the next week webinar, which will not be on Thursday, will be on Tuesday. That is a special webinar with a complete strategy. And then the main topic today is filters. Filters or indicators, or however you want to name them. And what I would like to do here is to guide you to a different view on filters or indicators at all. And that is quite important, that we don't think too much from the trading perspective concerning filters or indicators. It's much more general what we can do there. And then, of course, we can learn from other disciplines. And that will help us for our trading finally. And what I will present here has to do with the so-called Swiss Army knife filter that has been introduced by John Ehlers, and I will refer to his paper on that as well, because it helps to understand what he is doing and his view on filters. His view comes a little bit more from an engineering perspective, and that is related to more signal processing. You might think, well, that has nothing to do with trading, I want to trade. But you will see that our prices, what we trade, whatever underlying we trade, is nothing more than a series of data, and that is closely related to signals in a broader sense. So that are the topics for today. Let's go into it. And let's start with the questions from last week. And you might remember that I have introduced the so-called lead lag strategy, looking to 6 exchange rates, all related to euro in the first name, so to say. And then the task has been to find the strongest and to find the weakest within those 6 pairs. And last week I simply have done it visually by looking to an EMA within the chart. But finally, we have to measure a little bit more precise, and that means we need to measure really the angle, the slope of that EMA. And yeah, there's an indicator available which is called MA angle, and you find it directly if you go to Google and search for that. Yeah. And what does that indicator is doing? Therefore, let's switch to this MT4 screen with the lead lag strategy. That means here I have those 6 pairs in this case on a time scale H1, 1 hour. And you see I have euro, Australian dollar, Canadian dollar, Swiss franc, British pound, Japanese yen, and finally US dollar. And the task now is to find which one is the strongest, and with strong I mean having an EMA indicator with the strongest slope, and the strongest positive slope, that it would be the strongest one. And looking to the chart, we see that there are several EMAs with a negative slope, and there's, for example, euro, Japanese yen having a positive one, and euro, Canadian dollar having a positive one as well. But now the question is, which one is stronger from both? Of course, we can simply have a look to the slope, but a look is not precise enough, and this indicator MA angle, which I have already shown, this one here, I have shown that indicator already on those charts, and what you have new in my charts now is that we have this bar graph here below the price curve. And you see in this case there are positive values and negative values, and what is here on this y-axis, on this y-axis, is simply the slope. And there is one small number that might not be that visible for you. There's one number, and that is really the angle of that slope. For sorry, that's but I cannot change the font size here. Therefore, the number is a little bit small. But the number in this case for euro Canadian dollar is 0.37, and we can compare now this number with the number of euro Japanese yen, and in this case we have a number of 0.23. So the higher slope we find for euro Canadian dollar, and we can do the same for finding the one with the most negative slope, and we have the numbers within those charts here, and then we can really find out which one has the highest slope, which one has the lowest slope. The indicator is, there has some colors, and those colors are related to a threshold. Let me double press here the indicator, and then you can see how it works. MA mode, that is related to whether it's a simple moving average or an exponential moving average, and so on and so forth. And then we have the period. And finally, what is relevant is the angle threshold. In this case, it's for me 0.51. And this is related from what numbers on you have. In total, we have here 3 colors. Red means the values are below minus 0.51. Blue means between minus and plus 0.51. And we don't have an example here. Maybe I enlarge one chart and we find a positive value. No, not within that chart. Let's have a look to another chart. Let's go for euro. Yeah, euro Japanese yen. Then you see in the beginning of the graph that there are green values. That means here we have had higher values for the slope. You can see it by your eye a little bit as well. But so it helps to find out, looking for the one with the highest numbers and with the lowest numbers. And by the way, what you can see here as well right now as the overall current situation, that most of the Forex pairs have no trend at all, and even if we go for D1 and then you can realize that there are only a few one having real slopes, and still it's euro, British pound, and it's euro against Japanese yen. And by the way, just to mention this one here as well, I use on every time scale, of course, I use different thresholds. And let's have a look what threshold I have here in my daily chart. Then you see that I have an angle threshold of 2.5. And how is that related to having a threshold of 0.51 in H1? That's quite simple. The time scale difference between H1 and D1 is for Forex pairs 24, because the day has 24 hours. And the relationship between my thresholds is then always square root like. That means from the threshold H1 to the threshold D1, the difference or the factor between is simply the square root of 25 in this case, because the time scale is different by a factor of 24. And the square root, once again, remember one of our first webinars, is simply because we know that price changes, and that is related to slopes of EMA as well. They are always square root behavior. They have square root behavior, and therefore I can have similar visualization effects by this threshold by applying this rule for the threshold itself. And that's quite cool, that otherwise if I would use always the same threshold, then for D1 I would only have, for example, colors like red and green, and within an M5 chart it would always be blue. So it would not help me, but I have, with this indicator, I have two things. One, I have the values, and the values are quite small written within the chart, and I have the color as well. So that helps me to find the strongest and the weakest. And then task is having both. Then we trade those against each other. That means in this case here we have the strongest British pound and the weakest Japanese yen. So we would trade British pound against Japanese yen. So that was the topic of last week's webinar, and that indicator helps a lot in order to identify the weakest and the strongest. Okay. That's for the question of last week. And let's now, not forget that there's a special webinar about class trading. Class trading has been topic within this webinar series already, but now within November we will start a strategy really related on class trading. We start with M5 based data, and I want to explain a little bit more in detail, more in depth, how that strategy is running, especially this one, which will be started within November on a live account. So some elements you might know already, but there are other people then joining that kind of webinar. So this will take place on Tuesday next week at 7 p.m. And by the way, there will be, it's not that important for this webinar, but there will be 1 week later a German webinar on that topic as well. So I will really go through from the idea to the complete trading strategy, and I have done some historical considerations on performance as well as on short-term performance up to now on a demo account, and finally that will be starting within November on a live trading account. And in order to get you the opportunity to follow that strategy, that can be done via this so-called Argonaut platform from Argos FX. So the link for registration is the following. Just a second, and now here it is. So if you want to register for that webinar as well, it has a different link, so therefore it needs its own registration procedure. So this is around class trading for next week, and that is one part of the reason that we don't have a webinar on Thursday next week, so not to have too much webinars within 1 week. So now to our main topic for today, and the main topic should be filter and indicator. And now I want to start from a more mathematical point of view, looking into that kind of things. Of course, everybody knows filters and indicators. Every trader knows them, and the list of potential filters is huge. And with every new trader, sometimes new indicators will be added and will be published. And yeah, so the list of indicators is huge. But what does a filter originally is doing? From a mathematical standpoint, it's just a mapping process. It's a formula. It's an equation. And typically, what we do is let's call it, we transfer a certain history of data, price data in our case, looking to prices of stocks or forex pairs or whatever, and we have an equation or a transfer process. So it might be a complex one, but finally what we do is we have a certain history and we transfer that to a single number. That's all. And more or less every indicator is something doing like this. Mathematically, this is just a transformation or a mapping process, an equation, and nothing else. And our general aspect, our hope is that this one number should tell us more than the price history itself. Or at least what we try to do is that we can easier understand what the market is doing. And you might remember that we digged already into the topic of what is the predictive power of an indicator. And we know there are some indicators having a better one than the other one. But all we do is we do that mapping process. A certain history is converted or mapped or transformed into a single number. And even indicators like RSI, which is more an oscillator, and which is maybe in that language of transferring a certain history into a single number, might have some more calculations to be done. But nevertheless, it's just a mapping and nothing else. So indicators are only another way of how to look on a history of prices. And there are two principal categories of indicators. And one is having a so-called fixed history, and we have a very easy example for that. And an example would be the SMA indicator. So the single moving average, or simple, what is a better word? I don't know. So it has a certain history, like 100 candles, and then we take the average of those 100 prices, and this average is our value. but what is important, it has a fixed history. The other category is the so-called recursive indicators. We have, you might know, not directly know what that really means, but we have a very good example. The EMA is an example of that. And you might remember how we calculate EMAs in Excel. And the main difference between fixed and recursive is simple, that the output of last value is part of the input for next value. Or from another point of view, we have a feedback loop. So something from, let's say, yesterday is once again entering today in that kind of calculation. And that is recursive, or if you draw some nice pictures, then it has something like a feedback loop. Even in an SMA indicator, you can transform in something similar like that, but still it has a fixed history. So what sometimes is important, or people mention when I do SMAs or EMAs in Excel sheets, that they say, hey, we have to wait maybe 100 periods before we trust that value. The mathematical answer to that is absolutely correct. So we have to wait. But in principle, for EMAs, we have a problem, because mathematically, even the value, although it does not exist, but 10,000 years ago, would still enter to a very small weight into the today's value. So this indicator is in principle infinite in its history. Practically, we don't have to wait that long. So typically, if we wait for EMAs, the number of the period we take, the number of days or candles, then we have already a quite fair value. But that is more practical thinking. Mathematically, this indicator is infinite. That means the complete history is still to some certain extent within the today's value. But only that. That is two principal categories of indicators, and you can find them all around our typical trading indicators. Sometimes they are always in two versions. Even things like ATRs, which typically has a fixed history, can be transformed into a recursive one, meaning that it's more EMA-like. Same is true, for example, for Bollinger Bands. They exist in two kinds of ways, and always it's those two principal categories. Okay, let's now change our perspective from price to more signal. And with signal, I don't mean trading signal. So to say, now I send out the signal, I go long in euro, US dollar. No. Signal now is more like data processing, like a signal of audio, or whatever you think about being a signal. So I don't want to relate it directly to what we think, like prices of underlyings. And if you think in general about a signal, then there has been, over the couple of decades and even several hundred years, there have been already done a lot of work about signal processing. And why not take that kind of work, or that work is already having been done, and look how we can transfer those logics, like those filters designed for signal processing. Can we adapt those this knowledge to our prices versus time? A good example is here noise reduction. Of course, there has been done a lot of work about noise reduction in signal processing, in audio signals, in video signals, especially before the digital age that we have today. But this noise reduction is very related to what we see when we look to our prices of whatever underlying, and we know those prices, they wiggle around, and why not call this wiggling around noise? And there are a lot of techniques from signal processing which have been developed, which might help to attenuate that noise in the price in order to see what is the, let's call it, the real price. Can we distinguish between this noise and the, let's call it, the true value or the real value, whatever that really means? Just a second. So now I'm back again. I just was coughing. So that was the origin for the interruption. Okay, and a good possible starting point for all those considerations, and I hope it will not be too complicated for you to understand what I do within the next couple of minutes, but sometimes I switch between two thinkings, and one is so-called time domain. That is something like our prices of euro, US dollar, or stock price versus time, or it is simply the voltage versus time, which reaches for an audio signal. But we can simply switch to the so-called frequency domain, and then we think in terms of, hey, there's a tone of 200 hertz overlapped with another one of 400, and so on and so on. And finally, we might listen an orchestra, whatever music they are bringing to us. So that is the more frequency domain. Frequency domain in terms of trading would mean, for example, hey, do we see something which repeats every 22 days, which would mean every month, or is there something every 24 hours, which would mean something repeats every day, and so on and so on. And do we have some oscillations, typical oscillations within our data? And all those things we can investigate from a more signal processing point of view. And that is how to change this kind of perspective. I have done, or what I want to introduce here is something which not I have invented, and even not really John Ehlers has invented. It is, yeah, but there is a very good paper from John Ehlers on his so-called Swiss Army knife indicator toolbox, which is a funny name, I think. And you might find today I have already, let's call it, sent around or make them available documents, and those documents you find within that panel window of GoToWebinar, and you can download those documents. And one is this PDF document, Swiss Army Knife Indicator. And what I will do is now I switch to that paper, and first I will go a little bit through that paper and how it works, and to introduce this filtering concept in a more general view and in a more general manner. And finally, I will show you an Excel sheet, because I have collected all those numbers and tables and kind of filters within one Excel sheet. And by the way, also that Excel sheet is already available under the documents, and you can download them as well. So this paper introducing this concept is not very long, and let me indeed go a little bit through it, because it might help you in order to better understand how this John Ehlers is introducing his Swiss Army knife indicator, which finally will be adapted to our Excel sheet. So in principle, he comes from this more signal processing world, and the reason is simply he's an engineer and having done a lot of work on that as well. And in order to introduce in general a so-called transfer function, of a discrete linear system, or in general a transfer function, it has always an output and an input. And this transfer function, is calculating something from this input to the next output, or the transfer function itself is just the ratio of both. And here is the equation is written a little bit more symbol-like, and this z power minus 1 does not mean mathematically 1 divided by z. No, in this case, it is, you should read it like minus 1 is 1 before. So in terms, think of a time series, we have today, and minus 1 is yesterday. So it's a candle, or the close value before. And just moving around that transfer function, whatever the transfer function finally will be, we can recalculate everything. And now let's focus on the last line here, that we have a new output, which is related to the latest input, and maybe the input one term before, and even the output of one candle, one unit before, is entering the new output as well. That sounds quite crazy, only like an equation and having nothing to do with what we intend to do here. But you will see in a second, it is very close related to what we are doing. Just if we have something like some values, some coefficients here set to 1, alpha, and so on. But then we have, for example, this equation. And if you remember how we calculate an EMA, then you see here exactly that equation. So that is the equation how I do the math in Excel, having a new input that would mean the close value of today. This is multiplied by this alpha, and then you add 1 minus alpha with the output, meaning the EMA value of yesterday, and that's all. So in this concept, for example, the EMA is already in. That's very nice. But to have it a little bit more complex, we can even think about, hey, we want to include not only a value of yesterday, the previous candle, or the input of the previous one, which would mean -2. And we can then, once again, have one single number or one single line like this one here. And even we think about, hey, we want to include one value long ago, this z power minus n, or this input value n candles before. Still, it sounds a little bit sophisticated what we are doing here, but the concept will give us a full set of filters. Having only this equation here, and this equation would need a couple of numbers, C0, B0, B1, and so on, all related, those coefficients related to some certain values of the current input, the input 1 value before, 2 values before, and so on and so on. This coefficients will now be our universal coefficient set, and we can set a good list of values to those coefficients, and that finally means that we can have, for example, an EMA. And still we start with that EMA. Then we need C0 equals 1 and so on and so on. Typically, in this equation we have finally only an alpha, and thinking about EMAs in our sense, we more think about periods like a length. For example, for a simple moving average, the length is simply the number of candles we average. Transferring that idea to an EMA, in all stock-related EMA indicators, you find an equation like alpha equals 2 versus the period plus 1. Okay, but in this case, to have it a little bit more general, it sounds once again a little bit complicated to having that huge equation here only in order to transfer a period. In period now means something like period of the EMA 200, or in the frequency domain, it's better to think about how many bars, how many should be come into it, and when should the attenuation should start. You will see what I mean with that. So it's only an equation how to come from one end to the other one. And even an SMA can be represented like this in this kind of equation. Before I go now to the next couple of filters, we can easily derive with the same kind of formula. We will look to a picture first, and how to show how that kind of filter works. The Gaussian filter, which is described above, is something similar to an EMA on an EMA, but I first want to show you how such a filter works. And such a filter works by attenuating shorter cycles. So it is a low-pass filter. You see it here within the chart. The green one is just an oscillating signal, and starting on the left side with a more higher period, a higher frequency, and then the period or the frequency slows down. So therefore you can see that the highs are more and more away from each other. Frequency-wise, we have on the left side higher frequencies than on the right side. Higher frequencies is something like noise, for example, in an audio signal. Same applies for price versus time of an underlying like euro, US dollar. And what such a filter now is doing is it attenuates the higher frequency and it lets through the lower frequencies. And that is exactly what we want. We want to remove noise. And the difference now between an EMA and this Gaussian filter, or the next one, the two-pole Butterworth filter, is only that the transfer function in the frequency domain is a little bit different. Typically, we think of filters in like boxes. So from a certain threshold frequency, no signal at all should go through that filter. That is hard to get, just even from a mathematical point of view. There are some techniques, but they have other disadvantages. But that is how such a filter works. And only by having a different set of those coefficients, once again related to one value, this alpha, which has to do with the cut-off frequency or cut-off period, because in our stock language we are more used to think about periods and not frequencies. There's always translation of how to calculate those coefficients out of finally what we call a period. And this always sounds a little bit complicated, but it's only simple math and nothing else. So we have now a tool set here. We just need another set of coefficients, and we get a new kind of filter. Let's go further. This two-pole Butterworth filter, I don't go into the details of that as well here, but mentioning already that an EMA, or this Gaussian filter, is a low-pass filter, we can also design a high-pass filter. So a high-pass filter is absolutely the opposite. It would take out all the low frequencies, and still the high frequency are there. Thinking about prices, and you will see in my Excel sheet what does it mean. We take out a trend. All trend behavior would be taken out because trends are low frequency domain. So we would get out all the trends and we have only what's remaining. And that would be a so-called high pass filter. Once again, you can have a two-pole high-pass filter, which is quite similar to the discussion before. And once again here, how the filter works. We have now on the left, once again, this higher frequency on the left, lower frequencies on the right. And you see now exactly the opposite behavior from this low-pass filter. Now, the low frequencies on the right hand, they are attenuated right now. And one can even combine things and create bandpass filters. That is even quite cool. And the examples mentioned already within the paper is that we want to use, or we want to look for cycles within our data. And you might remember that we have looked into seasonals, for example, but now we have the possibility to look into any cycle, either monthly or daily, weekly, whatever we want to have. So that is a so-called bandpass filter. And let's call it the design is only another set of coefficients, always for the same equation. So that is the real cool stuff here, that we have finally one equation, only we have different coefficients, and we can turn around between EMA, bandpass filter, and so on and so forth. So it's quite easy to have one equation, only with different coefficients, to create a new filter. This is very attractive, especially for those people who think about coding, programming those kind of filters, because you have only you more or less need one program with a different set of coefficients, and then you are done. Once again, we have now for such a bandpass filter. Let me show first how it works, because then it's more impressive. In this case, always we have the same input, this sinodal signal with a decreasing frequency, and such a bandpass filter now takes out a certain range of frequencies with a given width of frequency. And this width is now so-called a delta, finally entering in this alpha, but that is only math, nothing else. So what we have a value to say what period are we interested in and how sharp do we want to have it? And both values can be set within those equations if you go through all those formulas here. The same, we can arrange a band stop filter, which is exactly the opposite of a band pass filter. So let's look to the picture, then it becomes clear immediately. So then some certain frequency, one certain frequency is blocked, so the signal is taken out of that range. But always not exactly. There's always a width of frequencies which go through that filter, and that is only another set of parameters for the same equations for those kind of coefficients. This finally enters into just a table, and that is what's that cool here, to have it in any program code. We have only one set of coefficients, and in order to have different filters, the only thing is we have to change our coefficients. Most of them have only so-called alpha as the remaining coefficients, and this one would be related to a period, because we think in EMA periods, SMA periods, and so on. Two of them have two coefficients finally, the band stop and the band pass filter, because they have a central period which they are looking for, and then a width, so the tolerance range for that kind of frequency. So that is everything behind, and there's already a code here. And by the way, one remark: the table has at least one mistake, and the mistake is here. No, the mistake is, let me rethink. Bandpass. I have to scroll down. Bandpass 1 minus alpha and 1 plus. Okay, bandpass 1 minus, and here's the mistake. There it should be named 1 plus alpha. I realized that when I went to my Excel sheet in order to have everything there, and I wondered about the results. And then I have looked to the code here, and I realized that there's just one typing error, this minus against 1 plus. So now let's switch to this Excel sheet. But before doing so, let me make a remark, because I'm not interested in this SMA and everything which is related to more Fourier transform. I'm not interested in. Therefore, I can skip two lines of coefficients, and this one with the C1, because this is then always 0, and I don't have this N, because this is only related to those two filters. So you will find only the coefficients C0, B0, B1, B2, A1, and A2. Yeah, let's go to the Excel sheet, and I hope it becomes more and more interesting for you to have this kind of concept for filtering your prices in an Excel sheet, or even if you do it finally in MT4, programming your own indicators, whatever. So how is that Excel sheet here be set up? So it's quite simple. I have two filters, and the one only because I want to always to have the possibility to compare some things. So I have always a filter 1 and a filter 2, and then you see what I have done here. We have those coefficients like C0, B0, and so on and so forth, and then we have always this kind of equation behind. So C0 for an EMA is 1. and the B0 for an EMA is this alpha, and therefore this cell is related to this cell, and so on and so forth. And what I now can do here is always this finally goes like to this line with which is named actual, and the result here simply depends on what do you select, because now in those two yellow cells you can write what kind of filter you want to see, and if you write here EMA, then this line selects, oh, it's you want to have an EMA, so I go for this coefficients and so forth. So that's one element, how to use this Excel sheet. So you have only two yellow cells here, and you can change those not numbers or this wording, but of course it must be one word out of that and nothing else. Otherwise you get simply an error. So and the other one is we need those periods. If you have to really compare directly to this paper from John Ehlers in order to still remember when you have what kind of value. This period is related, alpha is related, for example, for EMAs, for Gaussian filters, butterflies, butterworths, and so on and so forth. And finally, when we have bandpass and band stop filters, then we need values for beta, the beta period, and this delta, this is a number between let's say 0 and 1, which represents the width, the window of that kind of filters. So it sounds everything maybe a little bit complicated, and I have done here a lot of if-else conditions in order to always calculate the right things, similar to this pseudocode in John Ehlers' paper. And now, simply let's have a look. Let's have a look on what happens here. What I have done here, I have in total, I have 3 examples: euro, US dollar on a D1 base, then H1, only the data from this year, and I have done something similar to this John Ehlers paper, this artificial work like a signal, which is then, in this case, band stopped. So these are the 3 examples, but let's go a little bit into it. What do you have here? In this case, we have the price of euro, US dollar, and I have not used the date. I have put an index before, because then I don't have this weekends gaps time-wise and so on. So therefore, everything is the x-axis is now such an index. And so the blue line is the price itself. And now I have here the comparison between 2 filters, the EMA and the Gaussian filter. And already they have, in this case, they have the same period for alpha, which in principle means they have the same period. Period like EMA 200, or in this case, it's an EMA 50. And you can think about periods in the more regular sense, like EMAs, SMAs in your chart. And I can now here, I can use the different values, and you see what happens typically. Now the price, or the EMA follows the price more sharply, more precisely, yeah. But now let's think from this other perspective, from this filter perspective, and let's compare those 2 filters. And what you realize here, for example, with the same set of numbers, both periods are set to 50, this Gaussian filter is a little bit more smooth. Look here in the middle, where now my cursor moves around. You have still those ranges where your EMA is not a straight line. So the yellow line is much more smooth. So it might be useful to exchange EMA against Gaussian in order to have it a little bit more smooth. It is not the same like increasing the period for the EMA. Let me do it. If I only increase the period for the EMA, you see those interactions here, they will still be there. Within the yellow line, you don't have them. So that is a more smoothing effect. So now the so-called lag, the time lag between those two filters becomes closer. It's more or less the same. I have to increase a little bit for about to the number 70. But still, now you see the advantage of this Gaussian filter. It follows the price still a little bit more exactly without wiggling around too much. So this kind of filter, yeah, is simply a little bit more smooth. So that might help in order to not follow every movement within the price. And this is related to what I call noise reduction. Now let's use a complete different set of filter. Let's use a filter like this high-pass filter or two-pole high-pass filter. So only by entering this number here, I get a new result. And now I have to go into the graph as well, because you see this yellow line is now more or less around the zero. Let's have a look into that more precisely. That means I have to select this graph or this line and have to relate it to the secondary y-axis in order that we can see what we finally see applying such a filter. And what now looks a little bit crazy here is everything without any trend, and it's exactly the oscillation-like behavior. So it's just the opposite. All the low frequencies go out, therefore we don't have any trend data anymore. Now we have the oscillation pure. So we enhance to see exactly those kind of oscillations. In order to understand this a little bit better, let me go into this artificial thing here, and having this kind of filter here as well, and let me use the same filter in both cases, that we don't have to think too much what we see here exactly. And just let me put here a slope, an overall trend behavior on this synodal behavior. And I even just can do it artificially by having this kind of equation here. And then our price looks like this one here. It goes up and goes up and up. We have an oscillating behavior going up. Applying that filter, immediately we get rid of the trend. So we are now pure in this oscillating behavior. We can realize it exactly, and we can look for periods like special periods, special behavior, in order to have finally, for example, trading entries at the upper end of this oscillating behavior. In this case, it would be easy because it's completely artificial, but in order to identify from a signal processing point of view those maxima and minima, this will help us by applying filters like high-pass filters, or even applying filters like bandpass filters. Then we can have behavior like this, that we can try to realize special periods within our data. And no, that was wrong. I need the number here. And we can try to realize especially those oscillating behavior within our data. It's not always quite easy for our eye to see it directly, but look here. We have those maxima, and you can much better see those maxima within the yellow line, and that is the advantage of this kind of concept of filtering the data. So my recommendation is simply play around a little bit with this Excel sheet and find your way for those kind of filters, how to use them really for trading. That will be part of one of our next webinars. But first is just to understand what this kind of concept is meaning to you and how it feels. So play around with those numbers. You will understand the Excel sheet, but only if you have next to you the paper of John Ehlers, this PDF document, because then you know in which case you have this alpha and beta and delta. So you need that kind of document as well. So up to now it sounds everything a little bit complicated, I know, but you will see it will help us a lot, because this smoothing, this getting rid of the noise, and not only up to now, I would say everybody has been on the level EMA. There are a lot of potential other filters which are related more to the so-called frequency domain. The EMA is just a low-pass filter, which can be done better by using some different, a little bit other coefficients. And we can do exactly even the other way around. Having not low-pass filters, we can have high-pass filters. And that is everything you can try out here with that Excel sheet. And you have two examples which are stock related, and there's one example which is, let's call it, artificial related. So, by the way, you can even change the periods, from the beginning period and the ending period here by those numbers. So, and you can play around with those filters. One remark here, that we have sometimes at the beginning this something which looks strange, that has to do with the beginning behavior of those filters and how that works. So let's call it an artifact, and it's not real, and you will see it only and always only at the beginning of those data. One additional other remark, what we have looked here within the D1 data of euro, US dollar is only a small fraction of data in order to understand what the price is doing, and or to understand how the indicator are working. You can move around here with your data window, so there are 4,000 data, but you don't see everything that exact if you not zoom into it, and therefore I have done here this zooming process. Wow, okay, my voice is still there, that's good, because I have one additional webinar today. And the time is already more than over, so we are already at the end after 12 o'clock. Hopefully you get a new insight into filtering and a new thinking about filters in general, and not only just applying any indicator to the next chart. Think about in terms of, hey, A filter is doing nothing else than converting a certain history into a single number. That's all. And the hope is that we get something which helps us for trading. But keep that principle in mind. And I think it's better to think about filters like EMAs and high pass, low pass, and filters more in the way introduced here by John Ehlers. And in order to understand it completely, first one has to get some experience with those filters, and then we can try to use exactly those filters for trading. By the way, John Ehlers has done this work already, and if you Google him on the web, you find much more, which is already completely trading with oriented. But nevertheless, we have first go through the details of his concept, and one is exactly those kind of filters. Okay, if you have any questions, as always, just send an email to friedrichowski@argus.com, and many thanks to Argus for having that kind of webinar. Yeah, and hopefully I see you next time on Tuesday, because on that special webinar, Thursday, then once again in 2 weeks. Okay, many thanks and have a good day. Bye-bye.